Але я тоді не зможу записувати питання. Тобто тоді вже ви питання записуєте.
Так, звичайно. Так,
I will
так.
not be able to record all the questions. I will do. Don't worry.
Так, вислала.
I've emailed it to you.
Поки ми вирішуємо технічні питання.
While we are trying to settle all the technical issues, I would like to welcome all the participants who have already joined us. There are quite a lot of them, and I would like to briefly remind you how we are going to work today. Today, we will discuss due diligence into the reporting. The recording of both days will be provided in the nearest future, and we'll inform you later about where you can find the recording. Today, we're also going to discuss the questions that we did not discuss yesterday. In the morning, I sent the questions to our dear colleagues from the OECD. And today, we will try to show all your questions with all the participants. Is for the procedure for Q&A questions and answers. It will be the same, but yesterday we saw several raised hands and we did not respond. That's why I would like to offer a different approach today. We are going to have a coffee break. It will be somewhere in the mid of the workshop. And you will be able to ask your questions by raising your hands. The questions should be dedicated to the topic that we will finalize before the coffee break, and also the same option will be possible during the Q&A session. Yesterday, we had a lot of questions, so please do not repeat them. We are starting with slide 37. Mariana, this is for you. And perhaps about security measures, if there is an error rate alert, please don't ignore it and go to safer places. And if there is the internet connection, you can join our session from there. If not, you will be able to come back to this workshop later. And also, I would like to remind that the workshop is recorded. That's why you will be able to get the recording of it later.
Okay, so we can start. Good morning, Colin. Good morning, Miguel. Thank you for joining us today. We are happy to see you. And I'm giving the floor to Miguel, and we can continue with today's topics. Thank you, Miguel.
Thank you very much, Daria. Colleagues from the Ministry of Finance and Tax Administration, and also colleagues from the private sector and financial institutions. Today, we're going to continue with the presentation. We covered yesterday quite a lot of the scope. So today, we're going to focus truly more on the actual due diligence requirements and reporting obligations that financial institutions should follow pursuant to the standard. We're going to, before moving to those obligations, we are going to finalize the scope by revisiting the definition of passive NFP that we studied yesterday, and also the definition and method to identify the controlling person of those passive NFPs that we discussed yesterday. Why, you may ask, we are revisiting this item? Truly is because it is one of the more important elements of the common reporting standard, and perhaps one of the most technical aspects of it, because passive non-financial entities, as Colin mentioned yesterday, can be used and are often used for aggressive tax planning schemes or aggressive evasion schemes to avoid paying due taxes. Of course, it is perfectly possible and legal to have an entity that is not having an active business, for example, because its whole purpose is to hold assets to generate this kind of passive income. Totally possible that is for a legal reason. It's totally possible that people that have those kind of structures are in this declaring their fair share of taxes in their countries of tax residence. However, what practice has shown is that they're indeed often used to as an aggressive tax plan structure to avoid paying taxes. So as we mentioned yesterday, the methodology to identify the classification of an entity pursuant to the CRS functions in a sort of dichotomy kind of way. We begin with an entity that can be a legal person or legal arrangement. And this entity has only two options. Either the entity is a financial institution, and in contrast, if the entity is not a financial institution, then the entity is a non-financial entity. If we have a non-financial entity, this kind of entities only have two options. The entity is either an active non-financial entity because of the 6 characteristics that Colin described yesterday. And if neither of those characteristics are met, then the entity must be considered a passive non-financial entity. Basically, even though the methodology to classify an entity as a passive non-financial entity is by ruling out the other options, by ruling out that the entity is a financial institution and then ruling out that the entity is an active non-financial entity, and therefore there is no positive definition of what a passive non-financial entity is. It's only done by ruling out the other options. We can generally say that a passive non-financial entity would be expected to include entities that whose sole purpose, whose main purpose and business is solely holding assets. And what kind of assets? The kind of assets that are used to generate passive income. Passive income is, as Colin described yesterday, the income that is solely produced for holding an asset and not because of a reason of an active business that the entity is conducting. So what are the main example? For example, debt interest is an asset. The receivable is an asset that is held, and because of the sole fact of holding that receivable, then the entity is generating interest. So that would be an example of an asset that is held to generate passive income, the passive income being the interest. Likewise, it can be the case of certain securities or even shares that are held solely for the purpose of obtaining the dividends or for obtaining the capital gains related to the sale or redemption of those shares or security. Those would be financial assets that are being generated, that are being held to generate passive income, the passive income being the dividends of the capital gains. Of course, first we will have to analyze if the entity that hold these kind of securities, and in this case, the shares, fall or does not fall in the definition of a holding non-financial entity. It may be the case that it does, and then it wouldn't be considered a passive NFE, but it may be the case that it doesn't, and therefore it can be considered as a passive NFE. And of course, we have one type of entity that, even though in principle meets the definition to be considered as a financial institution, if you remember the methodology that we described at the beginning, so entity, financial institution, non-financial entity. Even though this entity meets the definition of an investment entity and therefore the definition of a financial institution, investment entity that are the so-called type B investment entity or the professionally managed financial investment entity. These financial institutions, the main income of which is generating by trading in financial assets and that are professionally managed, as we mentioned yesterday, with discretionary power by another financial institutions. These type B investment entities, if they are located in a jurisdiction that is not implementing the CRS and therefore is considered as a non-participating jurisdiction, then this type B investment entities would be recharacterized for purposes of CRS and will be considered as a passive non-financial entity. What is the rationale behind this? The rationale behind this is that in passive non-financial entities, there is an obligation to look through the entity and identify who are the controlling persons or the beneficial owners of that entity. And then if those controlling persons are also reportable person or are reportable person, then the account held by that passive NFE becomes a reportable account. So in the case of type B investment entity that are located in a participating jurisdiction, in principle, there would be no need to look through. Why? Because financial institutions do not report financial institutions because that financial institution will make its own report. So no information would be lost if all jurisdictions are implementing the CRS because that type B financial institution, that type B investment entity will report the relevant information to the competent authority of the jurisdiction in which it is located. So no information is missed there. However, in this case, if the type B investment entity is located in a non-participating jurisdiction, then there is a lack of information. There is information that gets missed because that type B investment entity is not reporting CRS information to the competent authority of that jurisdiction because that jurisdiction is not playing by the rules of CRS. And therefore, as a defensive mechanism not to get that information lost in the way, is that that type B investment entity is treated as if it was a passive non-financial entity. And therefore, any financial institution holding an account of that entity will have to look through that type B now passive non-financial entity to identify who are the controlling persons of that entity and then identify if those persons are reportable persons. This is relevant because as we will see in the next slides, at the end of the day, the definition of controlling persons for passive non-financial entities, an account holder for certain type B investment entities, primarily trust or partnerships, is going to be quite similar. So at the end of the day, we will have the same information reported by treating these type B investment entities as a passive non-financial entity. If we can move to the next slide, please, to go in a little bit of further detail to the definition of then what is the controlling person that we've been going on and on about. The controlling person definition is based on and it's supposed to be, and it is exactly the same as the term used for beneficial owner in the context of anti-money laundering and fighting financing terrorism, used for FARA, for the Financial Action Task Force purposes. So what we are trying to identify here is the ultimate person behind those entities and that actually controls the entity and that actually benefits from the income derived from that entity. So we always make the distinction of legal ownership vis-a-vis beneficial ownership. Legal ownership is direct, so it can be a direct relationship with that with the other legal person or with the legal arrangement, and legal ownership can be held or can be held by an entity over another entity. So one entity can be the shareholder or another entity. That means that for those purposes, the first mentioned entity would be the legal owner of the shares of the second entity. However, in the context of money laundering and CRS, the beneficial owner is always a natural person. So we have to see not only the first layer of ownership, but we have to, as we mentioned, look through all layers of ownership between the underlying entity and any other interposed entity, legal persons or arrangements, to finally identify the natural person that sits behind that underlying entity. So who are going to be, what is the methodology to identify these beneficial owner or controlling persons for CRS purposes? We have two cases, basically. We have one approach that is applicable for entities that are legal persons, that have legal personality apart from their members or participants. And for this, it's generally used what we call the cascade approach. So it means that you have consecutive steps and you apply one after another. And under this cascade approach, the first step to identify who is the controlling person, the beneficial owner of a passive non-financial entity, is what we call the beneficial ownership interest. What is the beneficial ownership interest? It's an ownership interest either directly or indirectly. This means that that natural person holds the shares directly, or it holds their shares through an ownership chain that is interposed between the natural person and the underlying entity. And this ownership interest is such that it permits to that natural person to exert significant control over that entity. The threshold to define what is this beneficial ownership interest is left for every jurisdiction to decide what threshold is appropriate, considering its own circumstances, its own domestic context. However, for both FANAF standards and therefore also for CRS purposes, this threshold is not expected and should not be higher than 25% of the ownership, either directly or indirectly, acting alone or together in the underlying entity. Then the second step, because as we mentioned, is a cascade, a set of consecutive steps that we are following to identify the beneficial owner. If we do not identify a person that has a controlling ownership, or person, because it can be several persons that are the controlling persons or beneficial owner of the same passive non-financial entity. So if no person meets the definition of beneficial owner due to controlling ownership interest, or if there is doubt as to whether those persons are indeed the ultimate persons benefiting and controlling the entity, for example, because there may be some suspicious that these persons are not indeed the ultimate beneficiary, the ultimate beneficial owners of the entity, because they're merely a nominee or are acting on behalf of another persons due to an undisclosed or non-formal arrangement, then the entity, the financial institution performing the customer due diligence procedure, a second step of the cascade approach, would be expected to identify any person exerting control over the entity through other means. And this term, through other means, is intentionally very broad and open to interpretation to be as broad as possible and to catch all situations as possible. Other means can go from the debt arrangements, whereas a person is providing financing to an entity, and under the terms of that financing, that person has the power to substantially influence the decision-making process of the entity, or has a substantial, or has a right to receive a substantial portion of the income generated by the entity. Then that would be an example of exerting control through other means. It can be not only this type of formal arrangement, a financing funding arrangement, but it can also be close relationship and historical relationship with the entity. So for example, a mother that is the actual owner of, the actual beneficial owner or ultimate beneficiary of an entity, but then puts the kids or maybe the husband as the shareholders of the entity. So they are interposed, but it's the other person who makes the ultimate decision. So this kind of situation would be expected to give a reason to know that that person is the one actually exerting the control over the entity through other means. As final step of the cascade approach, and this should be a last resort kind of situation, when there is no person identified as exerting control over the entity through beneficial ownership interest or through any other means, then the financial institutions will have to identify the senior managing official of that passive non-financial entity. So what does this mean in practice? This means in practice that all and completely all passive non-financial entities must always have a person identified as the beneficial owner. If we do not identify the person, the natural person exerting control to beneficial ownership interest, then we look for person exerting control through any other means. And even if we do not identify any person exerting control through any other means, then we need to identify the senior managing official. So at the end, at least one natural person with respect to that passive non-financial entity is identified. This identification of the senior managing official should be in practice in very limited circumstances and not a default option. So it should only be when indeed there's no one identified as the actual beneficial owner and there's no information either publicly available or in the records of the financial institution, giving reasons to know that there is such other controlling person. Jurisdictions can opt not to go through the cascade approach. Jurisdictions are, of course, able to decide what is called the simultaneous approach. So it's not steps, one after the other, consecutive, but it's a definition that you should apply in every case. So jurisdictions that apply the simultaneous approach instead of the cascade approach must identify both the controlling persons due to beneficial ownership interests and also the controlling persons due to control by other means in any case. So even if there's a controlling person due to beneficial ownership interest, there's also the requirement to identify beneficial owners due to control by other means. And at the last resort, the senior managing official. So jurisdictions are free to decide the cascade approach or the simultaneous approach as of today. And these rules that are generally applicable to legal persons, especially legal persons whose decision is based on equity participation in the entity, so number of shares, number of securities held in that entity, may not be appropriate for other kind of entities, especially legal arrangements that by their very nature do not have this type of equity participation, of control based on equity participation. The most clear case is trust. So in the case of trust, there is a specific methodology to identify the controlling person of the trust, and they should be always a natural person that is either a settlor or any natural person that is behind interposed entities that are acting as settlor. And the same goes for trustee, protector, beneficiaries, or classes of beneficiaries. And in addition to that, any other natural person that exerts ultimate effective control over that trust should also be treated as a controlling person. So it is a very broad definition and tries to catch all possible situations. So what would be an example? Because in trust, pursuant to the laws of several jurisdictions, the settlor and the trustee and the beneficiaries can be not only natural person, but can be also entities. For example, in the case of settlor, that is a legal person of a trust, then in order to identify the beneficial owner of the underlying trust, then the entity will have to identify also who is the beneficial owner of the interposed entity acting as settlor. So we will look through that entity that is the settlor to identify the natural person behind it. The same will apply for trustees, protector, beneficiaries, or classes of beneficiaries that are entities and not natural persons. We always look through them to identify the natural person that is behind them. And because not only trusts are the legal arrangements covered by the CRS, but can be any other type of legal arrangements. The persons or natural persons that are in similar positions to a trust, trustee, protector, beneficiaries, or classes of beneficiaries, and any other natural person exerting control over that legal arrangement should be treated as a controlling person. What is an example of these equivalent or similar positions? For example, in cases of foundations, where foundations do not have legal personality apart from its members, and therefore are considered as legal arrangements, then we have a founder that is transferring some assets for the purpose of the foundation. So that founder is an equivalent position to that of a settlor in a trust, because they're both transferring assets for an specified purpose. Then we have the foundation council, who is in charge to administering the assets of the foundation to achieve the purpose of the foundation. So that is a position that is similar or equivalent to a trustee, because they both have a fiduciary responsibility to administer assets that were transferred to them, not as part of its own state, but for a specific purpose that was set by the founder or the settlor, as the case may be. And of course, they both have beneficiaries, the trust and foundation, the persons who are going to benefit from the activities of the trust or the foundation, as the case may be. So that's an example of persons that are in equivalent positions on legal arrangements, trusts and foundations. Of course, the standard do not include a description of every legal arrangement and what will be considered as a similar or equivalent position, because there are many types of legal arrangements, and therefore it would not be possible to cover all. So instead of doing numerous clauses list of what is considered the beneficial owner or controlling person of a legal arrangement, the standard uses the example of a trust, and then it provides that persons acting in similar or equivalent positions in other legal arrangements should also be considered as a controlling persons. Quick note here, for FATF purposes, for AML purposes, there's often the obligation to identify the beneficial owner of any customer that the financial institution, or more broadly speaking, the AML obliged person has. Whereas for CRS purposes, there's only the obligation to identify the controlling persons of certain type of entities that are customers of that financial institution. So as we mentioned, that would be only account holder that are considered non-financial entities, and there are considered passive non-financial entities. So of course, there is no need to identify the controlling, for CRS purposes, there is no need to identify the controlling person of an entity that is a financial institution, or the controlling person of an entity that is an active non-financial entity. So this would conclude the scope, the first 3 steps that we talked about yesterday. And now we will move into a little bit of further detail into the actual customer due diligence and reporting requirements. If we can go please to the next slide. So you can see here, we went to the first 3 steps. We saw what is the definition of a reporting financial institution who have the obligation to conduct due diligence procedures and report information pursuant to the standard. So who have that obligation. Then we saw what is the definition of financial accounts. So what are the products that fall within the scope of the CRS and with respect to which we have to conduct due diligence procedures and report information. And then we saw what within those universe of financial accounts, what are the reportable accounts, what information, what type of account is the ones that the actual, that there's going to be a requirement to report information once they're identified as reportable through the application of the customer due diligence procedures. And now in the steps 4 and 5, we are going to see first the how. How do we identify those reportable accounts within the financial accounts? And then we are going to see what items of information do we have to report pursuant to the CRS once we identify the reportable accounts by applying due diligence procedures to all financial accounts. So let us begin now with step 4, the due diligence rules. This item is going to be rather complex and long, so it's good that we are approaching to the coffee break. So maybe we can cover a little bit, maybe the pre-existing accounts, new accounts for individuals, and after the coffee break, we can see entities accounts. So if we go to the next slide, please. As just a quick reminder, as we mentioned earlier on, financial institutions have products that they offer to their clients. And some of these products may fall into the definition of financial accounts, and others may not fall. So in principle, if they don't fall in the definition of financial accounts, for example, certain types of loans and mortgages granted by the financial institution, not a financial account for purposes of the standard, so they are not within the scope, and there is no need to perform customer due diligence. And also products that in principle do fall within the definition of a financial account, for example, because they are a depository account or a cash value, insurance contract, or equity of debt interest in an investment entity, but because they meet the definition of an excluded account, then they are excluded from the definition of financial account, and therefore for the purpose of conducting customer due diligence and reporting on those accounts. So having that in mind, once we have the scope of the products that are financial accounts for the purposes of the standard, and therefore we have to conduct customer due diligence procedures and report information on those accounts. For purposes of how to conduct the customer due diligence, we divide those financial accounts into 4 categories: pre-existing individual accounts, new individual accounts, pre-existing entity accounts, and new entity accounts. So what is the rationale behind this? To have these 4 different types of customer due diligence procedures: first, pre-existing and new, and then individual and entity accounts. And the first one of which, pre-existing and new. It is recognized that once the CRS is implemented in a jurisdiction, the financial institution already have onboarded customers and already have clients which the financial institution has a business relationship that pre-exists the CRS. So the financial institution may have not been aware at that moment, so there was no obligation, for example, to collect a self-certification or a specific requirement to obtain the tax residency of that account holder. So that is recognized, and because there was no such obligation, then the procedures for pre-existing accounts rely mostly and in general on what we call indicia. Indicia because there was no requirement to have a positive affirmation from the account holder, the self-certification on where the account holder is a tax resident of. So that's the first distinction. Pre-existing accounts, we are going to rely mostly on indicia, on information that is already available on the files of the financial institution or information that may be otherwise publicly available. Whereas for new accounts, because now there is such an obligation that is already in force and financial institutions know about it, and they're supposed to collect all the relevant information from the customer before completing the onboarding, is that for those new accounts, we do not rely on indicia as a general rule, but we rather rely on a document that is the self-certification, the positive affirmation of the account holder on where she, he, or it is a tax resident of, and all of the other elements of validity of the self-certification that we will describe. And we have the distinction of individual accounts and entity accounts because, of course, individuals, we only have the account holder, and that's it, the natural person holding the account. Whereas for entity, we have to make the classification of the entity, where the account holder is financial institution or non-financial entity. And if it's non-financial entity, whether it's passive or active, and if it's passive, we have to look through and identify the controlling person. So because of the level of complexity of individual accounts compared to entity accounts, and because of the requirements already in place for new accounts compared to pre-existing accounts, is that we make this distinction on the customer due diligence procedure. So we can start with pre-existing individual accounts on the next slide, please. We have basically two procedures. One procedure that is applicable to low value accounts. This is accounts that have value of less than 1 million USD. And we have procedures, enhanced procedures to high value accounts. These are accounts with a value of course, 1 million USD or more. The procedure for lower value accounts is quite straightforward. First, we have an option that is to rely on the what we call the residence address test. This is where there is a residence address recorded in the files of the financial institution, and to the extent that that residence address is supported by documentary evidence, then the financial institution can choose to treat that account holder as a tax resident of the jurisdiction for which it has recorded a residence address in its files. If there is no such information, or if the financial institution chooses not to apply the residence address test for a low value account, then the financial institution is expected to conduct the so-called electronic search for indicia. So it would be consulting the information that is electronically available in the file of the financial institution and look for indicia, indications that the account holder might be a resident, where the account holder may be a tax resident. So this could include, for example, the residence status that that was recorded for the account holder, whether this is supported by documentary evidence, but there's others indicia. For example, what is the mailing address of that account holder? If the account holder has a telephone number in a foreign jurisdiction but does not have a number in the jurisdiction where the financial institution is located. So there's a number of indicia that give us an indication of whether the account holder is a resident in a reportable jurisdiction. So that would be the two steps for low value accounts. Either we conduct the residence address test if possible, and if the financial institution chooses to do so. If not, we conduct the electronic search for indicia. If we go to the high value accounts, we have additional procedures. So we will have to perform also the electronic search of indicia. But if all of the elements described as indicia are not available in electronic records, then the financial institution must also perform the paper record search to identify the indicia for those high value accounts. And on top of that, in indicia search, either electronic or also paper search, the financial institution must conduct the inquiry to the relationship manager of that account, because these high value accounts are often assigned to a relationship manager who is in close relation to the account holder and often knows the relationship, often knows the situation of the account holder. Is that the financial institution should be expected to ask this relationship manager whether it has any information, any indication on where the account holder could be a tax resident of. If we go to the next slide, please, we're going to find a little bit more detail on the requirements to apply the residence address test for low value account. The first one is optional. So financial institutions can choose to do it or can choose not to do it, and therefore then rely on the electronic search for indicia. But if the financial institutions do choose to rely on the residence address, then there's two requirements that need to be met. First, this residence address recorded must to be current, meaning that it must be up to date. And second, that the information must be based on documentary evidence. So documentary evidence can include a range of documentation that confirms the residence address. For example, utility bills or government issued documentations or audited financial statements. All of those can be documentary evidence to support the residence address of an account holder. If they choose, if the financial institution choose not to conduct the residence address test, then they must perform the search for indicia. If we go to the next slides, please, we are going to see what is the actual indicia, the list, the complete list of indications of that account holder, that one account holder may be a resident of a portable jurisdiction. So the first one is, of course, the resident status, where the account holder recorded to be a resident of, but also we have more soft indicia as we go further. So we have the mail address, or we have the telephone number with a two-step requirement. So there is a telephone number in a foreign jurisdiction, and also there is no telephone number in the jurisdiction of the financial institution. So for example, if Miguel goes to an Ukrainian bank and provides two phone numbers, the Ukrainian telephone number of Miguel and the French telephone number of Miguel, then there is no indicia there because I provided both the Ukrainian and the French. However, if Miguel goes and it only provides the French telephone number and no telephone number in Ukraine, then there is an indicia to suspect that Miguel might be a resident in France, and therefore, if that's the case, get reported under the CRS. In the case of specific types of accounts, for example, depository accounts, there are particular indications, the so-called standing instructions to make payments or transfer funds to another financial institution that is located in another jurisdiction. So for example, Miguel has a depository account in an Ukrainian bank, and it has instruction that by the end of the month, all of the funds or a certain amount of the funds is transferred to a French bank. Then there's an indicia that Miguel might have a nexus or might be a resident in France. And then we come to the what we call the more low, the softer indicia that can even get, even if there's only these two indicia, can get the account to be identified as the undocumented account, the in-care address of the power of attorney. Those are very soft indicia. The rule to determine whether one account is a high value account or a low value account, the first rule that we have to take into consideration is the aggregation rule. So we should consider all of the accounts held by an account holder to consider whether the accounts are high value or low value, and to the extent that the systems of the financial institutions allow for these aggregations to treat the financial accounts are one, for example, because there's a client account under which all of the account numbers can be identified. So in this example, Miguel, that is an account holder, has an account of $500,000, and then it has a second account in the same bank of $500,000 plus $1. So none of those accounts, neither of those accounts by itself surpasses the threshold to be considered a high value account. However, the balance, the aggregated balance of both accounts indeed surpasses the threshold, and therefore both accounts should be treated as high value accounts, and the customer due diligence to be applied should be those enhanced customer due diligence for high value accounts. The indicia of tax residency, we put tax residency here on the brackets because we are truly only looking for indicia of residency, and then we are making the assumption that where you have your residency, you have your tax residency. It follows the steps that is first on electronic records and then on paper search for high value accounts. And it's important to bear in mind that because we are relying on indicia and not actual information on the tax residence, it's information that may not be accurate. It may be very well possible that Miguel indeed has only provided the French the French telephone number to the Ukrainian bank because Miguel has not obtained a Ukrainian telephone number, but Miguel is a complete full tax resident in Ukraine and not in French. So it may be very well the case because we are relying on indicia, not actual information. So because of that, the standard allows for a procedure to cure the indicia. In that case, where a financial institution identifies one or more indicia, it has two options, the financial institution. Either it considers the account holder to be a tax resident of the jurisdictions of which the indicia was found, and in the case of a reportable jurisdiction, then consider the account as a reportable account. Or as a second option, it can try to cure the indicia. So it can try to obtain a self-certification from the account holder supported by a documentary evidence, that self-certifications to cure the indicia and confirm that even though there's an indicia, the account holder is not a tax resident of that jurisdiction. So that can be applied for both high value and low value accounts. There are always the possibility, the options to cure the indicia. It is not a requirement per se, but it is rather an option. If indicia is found that the account is reportable to a jurisdiction, then we report that information. If not, if we are able to obtain the self-certification and documentary evidence to cure indicia, then we can also choose to do that. And the relationship manager inquiry is something that we have to do on a yearly basis. So on a yearly basis, we ask the relationship manager whether it has any information that might affect a change in the status of the account. And if so, we further investigate to see if this gives us more indicia or indication of where the account holder is resident of. And of course, we also have to conduct the aggregation rules and the thresholds verifications on an ongoing basis. So for example, if an account does not surpass the threshold to be considered a high value account, but then later in the following year, it indeed surpasses that threshold, and therefore we need, then in that case, we would need to trigger the enhanced customer due diligence procedure, because even if we did not have to conduct enhanced customer due diligence procedures at one moment in time, because at that moment the account was a low value account, If later in time that account becomes a high value account, we have to conduct the enhanced customer due diligence procedures with respect to that account. And of course, we must always and continually follow up on the documentation on the file. So when we complete the customer due diligence, let's say in a given year, if time comes and later the account holder comes and updates the file, or because we have to update the AML, the anti-money laundering file every year, every 2 years, or every given amount of time provided by the domestic law of the jurisdictions, then we will have to update the information of that account holder. And if we come across in that process of new information that confirms that the account holder is a resident of a reportable jurisdiction, then we have to treat that account holder as a reportable person. So in the next slide, we will finally see a summary of some of the differences that we have for individual lower value accounts and for individual high value accounts. And the first one is with respect to what we call the whole mail or in-care address indicia. As we mentioned, these are low, so for these are soft indicia. So if we identify this indicia for low value accounts, we can decide to treat them as undocumented accounts, whereas that is not possible for high value accounts, and we have to perform the enhanced search for indicia and obtain self-certification or documentary evidence if needed to cure the indicia. And of course, we have the difference that the paper search for indicia in the case of low value account is not required, whereas in the case of high value accounts, that search of indicia, it is required. If we move to the next slide, please, just to quickly see what's the procedure now for new individual accounts in the following slide. And we are at the hour. I don't know, Daria, Colin, if you want to push a little bit further for new accounts, or if we want to have the coffee break now.
I think, hi, Miguel. I think we can finish this new accounts and then we take a break probably.
Yeah, we can finish this part, and then we have one hand raised. We can answer the question, and then we go to coffee break, if you don't mind, Miguel.
Perfect. That sounds fine. If we can go to that, it's going to be rather short explanation because I think that is the previous slide, please. The previous one. Yeah, exactly. We're an individual account. So as we mentioned, the process for new individual account is quite simple. We obtain a self-certification and we control the validity of that self-certification. So in the next slide, now we can see what is the requirements for a self-certification to be considered valid. So we always have to collect a self-certification upon opening in the account. If we can go to the next slide, please, to show it on screen. Thank you. So we always obtain the self-certification, and the requirements are quite clear. The self-certification must be signed or otherwise positively affirmed by the account holder, and must include at least the name, residence address, jurisdictions of residence for tax purpose. And we have this in plural because it can be the case, it may be the case that an account holder is resident for tax purposes in more than one jurisdiction, 2 or more. And in that case, we will have to obtain the tax identification number for each jurisdiction for which the account holder is considered to be a tax resident of, and of course, the date of birth of the account holder. So these are the elements of validity of a self-certification. So we obtain that document, but we cannot only rely on the self-certification provided by the account holder. We must also control the reasonableness of that self-certification, what we call the reasonableness test of the self-certification. And that process goes to verifying that information contained in the self-certification, all of these elements, against any other information that is already available in the files of the financial institution. So for example, that would include any information collected pursuant to anti-money laundering and know your customer procedures, any documentary evidence that is already available in the files. So for example, if we collected utility bill showing that the account holder is a resident of jurisdiction A, but the account holder only completed that its jurisdiction of residence in the self-certification is jurisdiction B, then we have a reason to know that the information is not reliable. And if we have such indication that the information is incomplete or unreliable, then we have to approach the account holder to obtain a new self-certification that is accurate and is reliable. Or if that's not the case, then obtain a reasonable explanation or the documentary evidence to support the original self-certification. So in the example that I was providing, let's say that we have that utility bill for jurisdiction A, but I say in my tax resident, in my self-certification that I'm a tax resident of jurisdiction B, then the financial institution has reason to know that the information is not reliable and approached Miguel, say, Miguel, your self-certification is unreliable. We have reasons to know that your self-certification is unreliable. Can you please clarify or provide a new one? I said, yes, of course, I can clarify. I no longer live in that in jurisdiction A. Here's my new utility bill for jurisdiction B, and I would like to have my file updated, please. So because I provided new documentary evidence, the utility bill supporting my new residence in the in jurisdiction B, then the financial institution has lived up to the reasonableness test because it controls the reasonableness of the self-certification. So it's a really simple two-process. We obtain a valid self-certification with all of these elements, and then we control the reasonableness of that self-certification by comparing its content to any other information that is already in the files of the financial institution or that is otherwise publicly available to the financial institution. That would finalize the procedures for new individual accounts. As we mentioned, much more straightforward than for pre-existing accounts. And we can move to the next slide just to go back to the types of financial accounts for the different customer due diligence procedures. And I think that now we would be ready for that well-deserved coffee break.
Okay, we have a hand raised. I will just let the person speak. Vadim, I don't see your last name. You can talk now. Вадим, у вас звук відключений.
Vadim, your mic is off.
Добре, я думаю, можливо, Вадим випадково.
Okay, I believe maybe Vadim has raised his hand by accident. If that is the case, we will then take a break for coffee. Vadim, if you've stepped away but wanted to say something, then you would be able to ask your question during the Q&A session at the end of our meeting. Thank you.
I think that someone just raised the hand accidentally. So we will have a short coffee break and rejoin in 10 minutes, in 12 minutes, in 20 past 11 Kyiv time and 20 past 10 Paris time. I see a reaction from Vadim, but he doesn't talk. Okay, so I see you in 11 minutes. Thanks.
Thank you.
Вітаю всіх знову. Мар'яно, ви з нами?
Welcome again. Mariana, are you with us? Yes, I'm with you. In that case, I believe we can start if Miguel is also with us.
Yes, thank you. Here.
Okay, maybe I would take over. Hello, everyone. So Miguel has introduced the due diligence rules for existing individual accounts and also new individual account. So basically we have covered the requirements in relation to all individual accounts. But there is another case. Sorry, can we move to the next slide? Thank you. So in addition to the individual account, we also have the entity accounts. I think we may have mentioned that the reason we have the different treatment to pre-existing accounts and the new accounts, this is simply because it is impossible or not practical for financial institutions to obtain the information of the customers simply because of the CRS, especially in relation to the pre-existing account, because some financial institutions may have huge amount of pre-existing accounts. It would not be possible for them to contact every one of them to check where they are residents for a resident and then to identify if they are reportable under the CRS or not. So in that context, the CRS allows the financial institutions to rely on the pre-existing information they have already obtained for reporting purposes. So basically the general principle is for pre-existing accounts, the financial institutions do not need to contact, as a general principle, they don't need to contact the customer again. But for new accounts, they have to, and also it's very easy for the financial institutions to get the residency information of the account holder because it's a new account and they have to complete the related KYC or AML procedures. So it will be practical for them to obtain the residency information of the account holders. But you may ask us, if I don't have many account holders, for example, you are just, let's say, a fund reporting financial institution, and maybe you only have maybe a few investors which are account holders for that. And in such case, maybe it's very practical for you to obtain the self-certifications from all the investors for CRS purposes. Of course, that can also be allowed. It's an optional approach allowed under the CRS, which basically means you take the approach applied for new accounts to the pre-existing account. That can even better and even more accurate, because if you only rely on the information in your system, which information may not be, such information may not be up to date, may not be accurate. So if you, so that's why for pre-existing entity accounts, we, as Miguel introduced, for pre-existing individual account, we report based on indicia, but the indicia doesn't necessarily mean they are actually residents in that country. For example, you have a telephone number, as Miguel explained, in a country, it doesn't necessarily mean that you are resident in that country, but that's the approach for pre-existing account allowed by the CRS. So you can still report them based on the indicia, for example, the telephone number, because it's impractical for you to contact all of them to ask them to tell you where they are residents. So for pre-existing entity account, the logic is the same. For pre-existing entity account, the general principle is that you rely on the information that is available in your system because the client has been with you for maybe, let's say, for 10 years or 20 years. Of course, in your system, in your documents, in your files, you would have the information of that customer. But for new entity account, similar to the new individual account, because when the entity open the account with you, they will have to provide a lot of documents and information for other regulatory purposes, for example, for AML or KYC purposes. And at the same time, you can also ask them to provide the documents you require for CRS purposes. And also, as we similar to the all the individual accounts, we have to consider the excluded accounts, because if the account is held by an it can be categorized as excluded account, then you don't need to go through any of the due diligence procedures we talked about today. Next slide, please. Next slide, please.
Мар'яна, будь ласка, переключіть слайд. Дякую.
Yeah, please show all the. Thank you. So this is an overview of the entity account. So similar to the individual account, for entity account, we have a pre-existing entity account and also new entity account. But there is a big difference between the treatment of entity account and the treatment of individual account. Because for entity account, as we talked about yesterday, an account can be reportable under the CRS, either because the account holder, which can be an individual, or which can be an entity, they are reportable, or the entity account holder, which is a passive NFE. For such type of passive NFE, you have to identify further. There's a second step requirements to identify whether the controlling persons of such passive NFE are reportable or not. So for entity accounts, there is a second step. We call it 2 processes. The first process is that you have to identify if the entity itself is reportable or not. For example, in the case of Ukraine, if you are a financial institution in Ukraine and your customer is an entity, let's say it's a company set up in France. So France would be a reportable jurisdiction for you, and the entity is a reportable person, and then you will treat this account as a reportable account. But if the company in France is a passive NFE, passive non-financial entity, then you have another step to go, which is the so-called second process. You have to identify who are the individuals behind this company, who are the controlling individuals, controlling persons of this company in France, because the controlling persons may be also from reportable jurisdiction, like say from the UK. So because UK to Ukraine may also be a reportable jurisdiction. So in such case, the account is reportable account based on the entity is a reportable person resident in France, and also the controlling persons resident in the UK, which is a reportable jurisdiction to Ukraine. There may also be the case that the entity is reportable, the entities in France, but the controlling persons are not reportable. For example, the controlling persons are actually all residents in Ukraine. And in such case, you don't need to consider the controlling person's reportability because they are not reportable. They are domestic residents, but their account is still reportable. So for the second process to identify the controlling persons, we have to remember that it only applies to the case where the entity is a passive non-financial entity. So this structure or this flowchart just to help you to have a general picture of what entity account needs to be conducted in terms of the due diligence procedure requirements. Either it can be reported simply after applying the first process, or it can be a reportable account after you apply the second process, or the account can be reportable after you done the first and the second process. Both processes identified that the account is reportable. So there are essentially three scenarios in terms of the determination whether the entity account is reportable. This includes both the pre-existing account and the new account. Both of them, you have to apply the two processes as we have shown on this slide. Next slide, please. So in detail, for pre-existing account, as I said at the beginning, for pre-existing account, the logic or the general principle is that the financial institutions rely on the information it has already obtained for other regulatory purposes. This is to ease the burden of the financial institution, so they don't need to contact all the companies, all the entities again. But there are some detailed key elements for the due diligence of pre-existing entity account. We will explain it again in two processes. So the first process for pre-existing entity account, let's say you have 100 pre-existing entity account. So the first process is you have to check if the account is reportable simply because those pre-existing entities are reportable persons. They are residents in the reportable jurisdictions. Here we have to consider a so-called threshold, exemption threshold, because yesterday, I think someone asked the question whether under the CRS, we have similar exemptions to cash value insurance contract or depository accounts as we have under the FATCA regime. And the answer was no, because for cash value insurance contract and depository account, under the FATCA, they have the so-called 50,000 threshold exemptions, but under the CRS, we don't have such exemptions. However, for pre-existing entity account, we have such exemption. Again, the reason for such exemption is to ease the burden, to compliance burden of the financial institutions, because for entity account compared with individual account, for entity account, normally there would be more interactions between the financial institutions and the entities, unless the entity is the dormant entity or the entity is just a shell company, but that's a different story. But generally, for entity accounts, the financial institutions are required to obtain much more sophisticated information from them for other regulatory purposes. So here we have to remember that there is an exemption. The exemption threshold is $250,000 US. So essentially means, let's say for Ukraine, we are going to implement the CRS from 1st July 2023. And if by 30th June 2023, the pre-existing entity account's value or account balance is below this threshold, $250,000 US, you as a financial institution, you can choose to treat them as being an exempted account. But here we have to remember that if you apply this exemption, which basically means you don't need to do the due diligence, you don't check whether those accounts, pre-existing entity accounts, are reportable or not. But we have to remember when you apply this exemption, you have to monitor such accounts in all the following years, because in any of the following years, let's say by 30th June 2023, one pre-existing entity account has the balance or value below the threshold, below $250,000 US. But on 31st December 2024, basically the end of next year, the account balance or value is above this threshold, you still have to pick this account out and also do the due diligence to check if this account is reportable or not. So there is a requirement for you to apply this exemption. It's not like I apply this exemption on 30th June 2023, and then I just keep this account in a box and I don't touch them anymore. It's not like that. When you apply this exemption, there is a requirement that you have to monitor if this account, the account balance will change in any of the following years. If there is a change and the account balance is above this 250,000 threshold, you still have to take the due diligence procedures to such account and then identify if they are reportable or not. So there is a monitoring requirements or kind of precondition for you to apply this exemption. That's why in practice, some financial institutions, they may choose not to apply this exemption because they don't want to monitor the changes of the balance of value in all the following years. They just treat them as the normal accounts, and then they just identify their reportability based on the due diligence procedures because they don't want to monitor, especially for financial institutions. They don't have many financial accounts. If they don't have many, it's controllable and manageable. But if you have many financial accounts, and then maybe you can consider apply this exemption threshold, because this can ease the burden for you to apply the due diligence procedures. And also, but if you apply, as I said, you have to consider the monitoring in the following years. So that's the threshold we want to mention to you. It's a very important element. It's an optional provision under the standard, which basically means it's not mandatory. You can apply this exemption, or you don't want to apply this exemption. It's fine. You just treat them as the normal pre-existing entity accounts. The other point we want to mention is for pre-existing entity account, how to determine whether they are reportable or not. We have to check the information you have already had on your file, because as I said, for regulatory purposes, for this pre-existing entity account, probably you have already had a lot of information about this entity, about this company, for example. Let's say when they open the account, probably you ask them to provide a lot of documents about this company, about the articles of association, or even the annual audit reports, etc. So for those information, you have to check those information on file. And also you can check the information which is publicly available. For this kind of information normally refers to, for example, when you have an entity account, the account is held by a government or government agencies. And in such case, this is very obvious that the entity is a government entity, is a government agencies. And from public information, you can see that this entity is a government entity. Or you can also, from the public information, you can know that if a company say that they are listed, let's say in a established stock exchange, let's say in the London Stock Exchange, there is a company listed in a London Stock Exchange. And from the publicly available information, the financial institution would be able to know that this kind of information, which basically means this information should be already available to you, because you can easily, or maybe in your daily business, you've already known that this company is a listed company, because normally in your daily business, one of your customer is listed in a stock exchange. You would be able to know that they are listed in a stock exchange, and also you can know this through from the public available information, because basically you can check on the internet. And also you can obtain a self-certification because, again, for entity business, it's much easier for the financial institution compared with individuals. They are more likely to be able to obtain a self-certification. You can also obtain a self-certification from the entity. Just ask them to provide the self-certification to tell you where they are residents for CRS purposes. This is because for entities, especially the entities that have transactions, you can just, whenever there is a transaction, they have to contact the bank or the financial institution. You can just ask them to provide the self-certification, which is also an option. So the account can be treated as a reportable account if the entity account holder is resident in a reportable jurisdiction. I think this is easy to understand because the logic is the same as that for the pre-existing individual account. But the only difference is for entity account, we don't have the so-called indicia search anymore because it's a different structure. Because for entity account, we just determine where the entity is resident for tax purposes, and then this normally can be proved or justified in the documents provided by the entity. But for the pre-existing individual account, it can be a little bit difficult, or also a different structure. So they have the so-called indicia, like the telephone, like the other as indicia as Miguel mentioned. So this is the pre-existing individual account, the first process. Next slide, please. And for the second process, so we, in addition to the identification of the pre-existing entity itself, we also have to identify the second process, which is whether the controlling persons of the entity are reportable or not. So here comes the question about the classification of the entity, because yesterday we mentioned that there is a general principle that financial institutions don't report financial institutions. So if the entity, pre-existing entity, is a financial institution, that would be basically the end of the process. You don't need to apply the procedures for the second process anymore. But there is an exception, which is the case of the type B investment entity resident in a non-participating jurisdiction. We explained this yesterday because for this type of investment entity, we have to treat them as passive non-financial entities, which basically means we have to identify the controlling persons. So if it's a financial institution, basically, generally, they will be the end of the process. But for non-financial entity, we have to check if the entity is an active NFE or a passive NFE. Because for active NFE, basically that will be the end of the process as well, because for active NFE, you don't need to identify the controlling persons for such type of entities. But you may ask, how can I know that if they're active or passive? Again, this would be based on the information in your files and also the information publicly available, or you can apply or obtain a self-certification from the entities. Only for passive NFEs or investment entities, type B investment entities in the non-participating jurisdictions, we have to apply the procedures to identify the reportability of the controlling persons. But there are two different scenarios as set out in the standard, which basically means we have a threshold, which we have the kind of borderline, which is $1 million US. And if the account balance, let's say for your example in Ukraine, is on 30th June 2023, if the account balance of the account is more than $1 million US, which basically means they are high risk account. And for such a type of account, you have to take active actions, proactive actions to obtain the self-certifications in relation to the residence of the controlling persons. Because basically for those types of accounts, they are more risky. We don't want them to be missed out in the reporting procedure. So we the standard requires the financial institution to obtain the self-certifications from the controlling person. The controlling person will be the individuals. But if you're not able to obtain such self-certification, which can be possible in practice, and then you have to do the so-called indicia search if the self-certification is not reported. So basically, it comes to what Miguel introduced about the indicia search. Those indicia, as long as those indicia points to a reportable jurisdiction, then you will treat this controlling person as a reportable person. But for the accounts which are less risky, which basically means the account balance is less than $1 million as of 30th June 2023, and then you are not required to proactively ask for the self-certification in relation to the controlling persons. You can use the information on file to identify the residence of the controlling persons. So basically, for high-risk account, there is a requirement you have to proactively obtain the self-certification because that's more reliable information. But if not, you can only rely on the information on file to identify the residence of the controlling persons. But you may ask that, can I just ask everyone of the controlling person to provide the self-certification? Can I just ask my client, like the existing entity client, to provide the self-certification, including its classification, if it's whether it's a financial institution or whether it's an active NFE or whether it's a passive NFE, and also ask them to, in the same self-certification, to provide the information of the controlling persons if they are the passive NFE? Of course you can. And in practice, we saw that financial institutions normally, they ask the entity account holder to provide a complete self-certification to self-certify themselves whether they are financial institutions or not. If they self-certify themselves to be passive NFE, you also in that self-certification, you also ask them to provide the controlling person's information. So the conclusion is that based on the second process, the account probably will be treated as a reportable account because the controlling persons are reportable, or one of the controlling persons is reportable. But here, as Miguel introduced and emphasized, the controlling persons can only be individuals. This is the similar approach as you will need to do for identification of the beneficial owners under the anti-money laundering framework. So this is the requirements for the second process for pre-existing entity account. The very, I would say the basic principle is you have to look through. As you can see on the slide, we highlighted the word look through. You have to look through the entity to identify if those individuals are reportable or not. But again, if you look at the rules, for example, if you look at the Common Reporting Standard and the commentary of the Common Reporting Standard, or even you look at domestic rules in Ukraine, which are transplanted from the standard, you would be able to see that there are a lot of detailed procedure requirements. But as the application of such requirements of those procedures would really depends on the features or the size, for example, the size of the financial institutions. Again, if, for example, as I said earlier, if let's say if it's a fund, which is the financial institution, and let's say you only have 2 investors, and the investors are 2 companies, and the procedures for you to comply in the due diligence procedures would be pretty straightforward, because normally you would just choose to contact those 2 entities and ask them to, those 2 investors, and ask them to provide the self-certification. And if they provide all the information in a self-certification, and this would be the most reliable information for you to determine the reportability of this account. Because we have to understand the whole purpose of this due diligence for pre-existing accounts and also for new accounts is to determine whether this account is reportable or not. That's the ultimate purpose of the whole complicated, I would say, due diligence procedures. If you have the most reliable information, of course, that will be what the CRS due diligence procedures is pursuing for. Next slide, please. Now we come to the new entity account. For new entity account, it's more straightforward because for new entity account, you don't need to consider the threshold. What you need to do is basically just to obtain the self-certification from the entity. Compared with a new individual account, this may be even easier because for entity account, when they open the account with you, I'm sure under the AML framework, you would be required to obtain a lot of documents from this entity. And in such case, you can just ask them to provide a self-certification to self-certify their status, their classification, and if they are passive non-financial entity, they will also need to provide the information of those controlling persons. But there is a, as you can see on the slide, sorry, can we go to the next slide? Can we? Sorry, not next slide. I think we have something to show. Yes, okay, this one. So we have a box here. So there are certain scenarios that you probably don't need a self-certification, but even in practice, you can always ask your entity account holders to provide the self-certification, and that's what we have seen in practice. The financial institutions do. They just simply ask them to provide. You self-certify your government. You just tick your government, your financial institution. You just tick the financial. Sometimes they ask them to self-certify what types of financial institutions in self-certification. So it's actually quite straightforward. But there is a scenario that if you don't have the self-certification, but you can still determine the status of the entity, of the new entity, which basically include the information which is publicly available, or is the financial institution or not, or if the entity is a reportable person or not. Again, coming back to the case example I made, like if it's a company listed in the London Stock Exchange, then because for listed entities, they will not be reportable persons. So even though you don't have the certification, but you can obtain, you can easily know that from the internet or from public available information to know that this company is a listed company, let's say in the London Stock Exchange, then you can just treat them as not a reportable person, as simple as that. But at the same time, you have to keep there is a separate requirements for you to, because for all the due diligence procedures, you have to do the so-called record keeping. You have to keep the records, which basically to show that in the future, when there is a checks from the tax administration about your compliance procedures, you would have a proof to show that why you treat this company listed in London Stock Exchange based on what information. So maybe you take some documents downloaded or screenshots. And for such type of information, you have to keep the records to prove that this entity is not a reported person, because you don't have a self-certification. But if you have a self-certification, of course, you will keep the self-certification. But then when you, similar to the case of new individual account, when you obtain the self-certification, you have to do the reasonableness check. For example, if an entity just self-certified itself to be an active NFE, you have to do the so-called reasonableness check. The reasonableness check, it doesn't necessarily require you to be like a policeman to get the bottom out of everything. It only limits, or it only requires you to do the so-called checks based on the information you've already had. For example, for anti-money laundering purposes, the company tells you with some supporting documents that they are resident in, let's say, in France, or as let's say in France, yes. And then in the self-certification, when you ask them to fill in the tax residency information, they just tell you, I'm resident in Ukraine. So obviously there is a conflict or different information. And in such case, you may have to check with the client because this will not pass the so-called reasonableness check. Because reasonableness, as you can see from the name, is self-explanatory. It has to be reasonable. But the reasonableness check is only limited to the information that you have already obtained. You don't need to spend a lot of time to analyze, to determine whether each of the information they provided is reasonable or not. Because the self-certification, when the entity provide a false self-certification with incorrect information, or they just, for example, they are residents obviously in France, which is a reportable jurisdiction, but they lie to the financial institution and they provided a lot of justification or even fake documents. And then it would be their responsibility, because under the CRS, there is a sanction rules required to be imposed to the account holders when they provide false self-certifications. So for you, you just need to do the reasonableness check, which basically check against the information that you obtain for other regulatory purposes, normally the anti-money laundering or the KYC purposes. Next slide, please. So that's the first process, similar to the pre-existing one, but it's more straightforward because you just need to, in most of the cases, you just need to rely on the self-certification provided by the entity account holder. Next slide, please. And for new entity accounts, sorry, next slide, please. For new entity accounts, similar to the pre-existing account, we also have the second process, which basically means you identify whether the entity itself is reportable or not, but also you have to go a step further in the case where the entity is a passive non-financial entity. Again, similar to the pre-existing entity account, if the entity self-certify themselves to be itself to be a financial institution, that would be the end of the process. But of course, we have to pay attention to the type B investment entity case. So again, in practice, normally the financial institutions in the self-certification, they will just include all the details. For new entity account, they just ask them to self-certify. If you're a financial institution, they tick yes. And then the second question is, can you tell me if you are type B investment entity in a non-participating jurisdiction? So if they tick yes again, then they will have the following question to ask: could you please provide the controlling persons of this entity? Because they will be treated as passive NFEs. But if they tick they are financial institution and then they tick I'm not a type B investment entity, then that will be the end of the story, the end of the process until further exchanges in the future, change of circumstances in the future. But on the contrary, if they're not financial institution, they are non-financial entities. And in such case, again, if it's an new entity, you can easily obtain a self-certification from them. And then they will classify themselves. They will show their classifications and status to you, whether they are active in FE or not. If they're active in FE, in terms of the second process, that will be the end of the process because you don't need to identify the controlling persons. So the logic is the same as the pre-existing entity account. But is it a passive NFE or is the investment entity type B in a non-reporting, non-participating jurisdiction? Then you will only rely on the self-certifications to determine if the controlling persons are reportable or not. So the self-certification can be provided by the entity because when they open the account, I'm sure they will meet you, they will speak to you for all sorts of account opening procedure issues. And they will provide the self-certifications of themselves and also the controlling persons. But in some cases, maybe they just provide the self-certification of themselves, of the entities themselves. And in such case, the self-certification of the controlling persons can be separately provided in a separate self-certification, which is also possible. as long as you can obtain all the information as required for the passive non-financial entity. So here you can see that we don't have such requirements to report based on indicia anymore. It's only rely on the self-certifications, which is basically the same case as the case of new individual account. This also brings us to the general requirements under the CRS, which is for new accounts, including new individual account and new entity account. It will always be required to obtain a self-certification to self-certify, to determine whether this account is reportable or not. Because of the new account, practically you as a financial institution, you would be able to obtain the self-certification from the customers, whether it's an individual or an entity. The only point, as I mentioned in the previous slide, is just for new accounts, if you don't provide the self-certification, you don't obtain the self-certification, but you can obviously know that this entity is a non-reportable entity, a person. For example, the information from public available information, like it's obviously it's a government agency, or obviously it's a listed company in an established security market, and then you can choose not to obtain a self-certification, which is also allowed under the CRS. But again, in practice, what we've seen is that they always obtain a self-certification from the new account holders, no matter is new individual accounts or new entity account, because that's easy also from the FI's perspective to complete the compliance procedures. So those are all the information we want to share with you in relation to the due diligence procedures for entity accounts, pre-existing entity account, and also new entity account. For pre-existing entity account, we have the issue of the exemption. The threshold is $250,000. But for new entity account, we don't have such exemption. And if you apply this exemption for pre-existing entity account, you have to remember that you have to monitor in the following years. Of course, as I said, you can also choose not to apply this exemption. You can just treat all the accounts in the same way, which is also possible and also allowed under the standard. So that's essentially what we want to share with you for all the due diligence procedures in step 4, which is actually a very, I would say, relatively complicated procedure for the financial institutions to do. For the banks, for the custodian institutions, which normally for the traditional financial institutions, those would be relatively easier for them to understand and to comprehend and also to implement. Because for AML purposes, they have done a lot to identify the customer's status for other regulatory purposes, for anti-money laundering or know your clients KYC procedures. The challenging bit, the more challenging bit, I would say, is for the investment entities, because for investment entities, as we discussed yesterday, is a very broad term. It covers all the different types of legal forms. Some of them, for example, the trust, probably from the trustee's perspective, they've never touched upon some of the due diligence procedures before for CRS, specific for CRS purposes, or even they didn't know that for other regulatory purposes, they are not treated as a financial institution. But now under the CRS, the trust or the fund itself will be treated as a financial institution. And if you are a financial institution, you have to apply all those due diligence procedures. Again, the final point I want to mention again is for pre-existing entity account and new entity account, the ultimate purpose is to identify whether the account is reportable or not, essentially where the account holder is resident for CRS purposes. And if it's a passive NFE, you have to understand the controlling person's status, whether they are reportable or not. But the ultimate purpose is to determine whether the account is reportable or not. So the most reliable information to determine whether they are reportable or not, of course, is the self-certification from the account holder, because that's the most accurate, the most up-to-date information. You just ask them to provide the self-certification now, and then that will be the most reliable information. compared with the information you've already held in your file, because in your file, this may be the information provided a long time ago. Maybe it's not accurate anymore. But for purpose of ease the compliance burden of the financial institution for pre-existing accounts, the standard allows you to rely on the information you've already had, which basically means you don't need to contact the customer anymore, but you have to apply those relatively complicated procedures to identify whether the account should be reported or not. Next slide, please. And then after the due diligence rules, you will be able to determine whether this account is a reportable account or not. So if the account is determined to be a reportable account, the final question, the final step is what information will be reported. Next slide, please. If you look at the rules, of course, you have to, firstly, the general principle is you have to follow the domestic rules on the details, what information should be reported, because some jurisdictions, maybe they impose additional requirements in addition, besides the requirements of the standard, they also additional requirements to report certain types of information. So you have to always follow the domestic requirements. And this is relatively more straightforward because it's very clear that what types of information you report when the account is treated as a reportable account, and then those information will be reported, and then you just collect those information and then report it to the tax administration. We did a category. We didn't. If you look at the law, it's the rules. It's very clear that what the types of information should be reported. But here we did categorization. Basically, there are 3 types or categories of information. This is to help you to understand the logic and the rationale for those information to be reported. So 3 categories of information to be reported. The first is the identity information of the account holder or the controlling persons if it's a passive non-financial entity. So it's the identity information because from the other country's perspective, they will need to know, you send them a lot of account information, they will need to know who owns the account. What's the identity information of that account holder and also the controlling persons. That will be the name, the address, the jurisdiction of residence, and where available and required, the tax identification number, the date of birth, and the place of birth. Here, the jurisdiction of residence and also the tax identification number can be a difficult element. Sometimes you don't have such information, especially the tax identification number. So the OECD has published on this website the residency rules of almost all the countries, all the CRS countries on the website. So if you search on Google OECD tax residency CRS, and then you can find the web page of the OECD, which actually includes all the tax residency information of all the CRS jurisdictions. And also that's monitored by the OECD Secretariat and constantly updated. When there is a change of law in a specific country, they will tell they will send an update document to the OECD to update that web page. And tax identification number as well, because different countries, they have different format for the tax identification number, and some countries they even don't have the tax identification number. So from the financial institution's perspective, when you want to verify, when you want to check if the team tax identification number or the justification provided by the account holder is reliable or not, you can always refer to the OECD website in relation to the tax identification number rules of all the CRS implementing jurisdictions. But for the tax identification number, because it can be a difficult, challenging one in practice, and not all the financial institutions, they always have such information, especially for pre-existing accounts. So under the CRS, we have the so-called exceptions for providing or report the tax identification number. So there are two different scenarios, which is actually in the standard. I'm not going to read the details of the rules to you, but I just summarize and help to understand. The first type is for all new accounts and pre-existing accounts, you don't need to report the tax identification number if the tax identification number is not required or is not issued by the reportable jurisdiction. Let's say some countries, they confirmed on the OECD website, they say that in our country, we don't issue TIN. We don't have a tax identification number. But sometimes they say that we don't have a tax identification number, we have the equivalent number. So in such case, you still have to report the equivalent number. But some countries, they say we don't have the TIN, we don't have the equivalent number. So in such case, you don't need to report the TIN because for those countries, they don't issue TIN, and then of course, they can't provide the TIN by the account holders, and they don't need the TIN, probably they use other ways to identify the taxpayers. Or the domestic laws, they have TIN, but some countries, they have the domestic law to say that we don't need to collect the TIN for CRS purposes. And in such case, for example, I think in the standard, they mentioned the example of Australia. So they use other different numbers to identify the taxpayers. They don't use the tax identification number. And in such case, if they specifically indicate that under the domestic law, we don't need to require the collection of TIN. And in such case, you don't need to report the TIN. So basically, in such case, either the TIN is not available from the legal perspective, you want to report the TIN, but the TIN can never be available because the law in that country, they don't require the collection of TIN, or they don't issue TIN at all. There is the second scenario which only applies to pre-existing account. For pre-existing account, there is an exception for the reporting financial institution not to report the TIN. If in your record, you don't have the TIN of this pre-existing account, and also the domestic law does not require you to collect the TIN. For example, in your KYC or in your AML framework, they don't require you to collect TIN. You don't need to report the TIN for the pre-existing account, even though the other country may issue TIN. For example, let's say the pre-existing account is held by a French tax resident. And in such case, let's say in France, they issue tax identification number. But in your record, you don't have such TIN. At the same time, the local law, I don't know the details of the AML law, but just assume that suppose if the local law, if the domestic legislation for AML or KYC or any other regulatory rules, they don't require you to collect the TIN for such other law or legal purposes. And in such case, you don't need to report the TIN because it's for pre-existing entity account, it's for pre-existing accounts, and it's not in your system, and it's not required by the local law to collect the TIN. And in such case, you don't report the TIN. But there is a requirement for you to take reasonable efforts to collect the TIN because the TIN should be available. Let's say in the case of France, the pre-existing account holder, they should have the TIN, but it's just not in your system. So maybe you don't need to report for now, but you have to make reasonable efforts. The reasonable efforts should include, for example, you contact the account holder, like you telephone them, you send them emails, you send them mails to check, to ask them to provide the TIN. So there is a requirement for a reasonable effort to be taken if you don't report the TIN for pre-existing accounts. But the first category, as I said, again, it applies to both new accounts and the pre-existing account because that's the general exemption because the reportable jurisdiction, the other jurisdiction, they don't require the TIN or they don't issue TIN at all. And also they don't require anything in relation to the TIN like the equivalent numbers. And in such case, you don't need to report the TIN. I hope that's clear to you, but I think I would suggest that you look at the details of the rule under the CRS, and then it's very clear that in what cases you don't need to report. But here, I just to briefly summarize that, because this can be a tricky question in practice, whether they should report the thing or not, and this will also impact the quality you report to the tax administration, and also the quality of the information exchanged from Ukraine to other countries. The second category is the identity information of the accounts and the financial institutions. So from the receiving jurisdiction's perspective, when they know the identity information of the account holder and the controlling persons, they will need to know the identity information of the financial institutions and the account. This will help them to follow up. For example, if they have some issues they want to follow up, they will know which bank or which financial institution reported this information in relation to which account. So those would be the information reported. But again, here, yesterday we mentioned the account number, when we talk about the accounts, financial account types, we mentioned account number because not necessarily for all the financial account under the CRS, you would have the so-called conventional way of giving or issuing the account numbers. For example, the equity interest, let's say in the trust, the settlor would be the equity interest holder, but probably you don't have an account number. And in such case, you will find some identification number for such equity interest financial account. For example, the contract number or some other numbers you as a financial institution use to identify the existence of such stakeholder. But for the cash value insurance contracts, they normally have the contract number or policy number. You can use this as account number. So again, this is to identify the account. If it's not, you don't have the traditional account number, you can use the other numbers as long as they can be used to identify the account. And the name identification number of the financial institution, this is self-explanatory, easy to understand. And finally, the third category is about the financial information. So you know the identity information of the account holder, you know the financial institutions information and financial accounts information, then you need to know the financial information. So the financial information essentially includes two types of information. One is account balance or value. Easily understand this, which is basically refers to by the 31st December of a reporting year, what would be the account balance or what would be the value of that account. As for the activities or changes or transactions or movement throughout the year, you don't need to report that. You only need to look at the end of the reporting period. But you may ask, if I'm an equity interest holder, for example, I'm not if it's a depository institution, like depository account, you can easily take the number by the end of the year. What's the account balance by the end of the year? But not necessarily the case for all other types of financial account. For example, if it's an equity interest of the investment entity, let's say the trust, the example of the trust, probably you don't necessarily have the asset evaluation on 31st December, or you don't do that on that specific day. You do that, for example, let's say you have the annual report, let's say probably in June of the year, you can still take that as the account value of this equity interest, because basically it refers to trust asset value. And in such case, you take that as the account balance or account value. You don't necessarily need to, by the end of the year, you do the asset evaluation of all the financial accounts, especially for custodian account. That will take a long time, and it will be really time consuming. So essentially the principle is, for CRS purposes, if you don't have the account balance or value by the end of the year, especially for custodian account or for the equity interest, or even for the cash value insurance contract, you don't need to specifically do an evaluation by the end of the year. You can take any other most recent value. Let's say the cash value insurance contract. The insurance company normally annually, they will give a statement to the policyholder to show that what's the current surrender value or cash value of this contract. But it may be not sent on 31st December, it is sent, let's say, in June or in September. And you can also take that into account as the account balance or value for CRS reporting purposes. The other type of the financial information is the income information. So it's like, for each type of financial account, you have the balance, so value, and then also you have the income. Such types of income information should also be reported. So different types of financial accounts, probably they have different incomes. So we have some examples here, like a depository account. Normally it will be the interest, like the bank account you opened. By the end of the year, probably you will receive the total amount of the interest or the interest paid or credited to you. Those should be reported as the income information. For custodian account, it depends on what types of custodian account it would be. It also depends on what types of financial accounts under this custodian account. So the income type would be different. But generally we have this, for example, we have the interest, we have the dividends, or any other income, or any gross proceeds paid or credited. Here, gross proceeds basically refers to the sales or the redemption of the financial assets. For example, you sell, and this year you sell the financial assets, and what is the gross proceeds, and then you collect the information you report under this custodian account. But normally this only exists under the type of custodian account. For all other types of accounts, you report the gross amount paid or credited. So this is a catch-all situation because there are so many different types of accounts, so many different financial products, and the income type may be different. So you just report the gross amount paid or credited into the account. So that's the income information. For financial information, we report the account balance value, and also we report the income information. Finally, an important point we want to mention, which is the joint account or the controlling persons of a passive non-financial entity. Whether we should divide them. For example, there is a bank account, but the bank account is held by both the husband and the wife. But the account balance by the end of the year, let's say, is 1 million euros. When the husband is resident in the UK, but the wife is resident in France. And in such case, when the information you reported to France or the information reported to the UK, you can't divide them 50-50. You have to treat them as the whole value of the account. For basically, for the UK, for the husband, you have to treat the account balance of 1 million euros. For the wife in France, you also use the 1 million euros as the account balance. The same case as controlling persons. For example, if the account is held by a passive non-financial entity, it's a company which is a passive non-financial entity resident in Ukraine, but the company has two controlling persons. The two controlling persons are respectively resident in France and the UK. The account balance, let's say, is 1 million euros. And in such case, for each controlling person, the controlling person in the UK, controlling person in France, you can't divide the 1 million euros. You have to take the whole value, 1 million euros, for each controlling persons. You don't do the so-called dividing them into a certain percentage. You just treat them, as long as it's a controlling person, you attribute all the total assets or the total account balance to that controlling person. So this is the important point we want to highlight here, because in practice, some financial institutions, just based on the self-understanding, they just do the division, but that's not correct under the standard. So to summarize, for the reportable information, again, it really depends on the financial institution's infrastructure, because if you are from a big financial institution, probably you will establish a well-established system to gather those information based on the local requirements in your domestic law. But if it's a small financial institution, you have a very small number of financial accounts, and then probably you just check against the details of what information will be required and then submit the information as required. And final point on this slide is, as you can see, we are talking about transparency. We're talking about the information used to fight against the tax evasion. But here you have to remember that for pre-existing accounts, we relied on the indicia, we relied on the pre-existing information, which may not be accurate. So the information exchanged to other countries, including the information about financial information like the income, it doesn't necessarily mean those amounts can be used to calculate the taxable income. Because in most of the cases, it will not be used because those are just raw data exchanged to countries. And those countries receiving the data, they will do some further investigations. They will do some further checks. They will use some other mechanisms to get more information to establish a tax investigation or tax audit case. They will not necessarily just use you report income of 1 million and then they just calculate 20% of income tax based on that. They will, because those are just raw data. They need verification, they need further checks, they need more information on this. The ultimate purpose is to achieve transparency. That's what we are basically talking about because this is the international tax transparency standard. So this is what we want to basically share with you today, like the due diligence rules and also the a quick summary of the information needs to be reported under the CRS. Those are the important or issues or the issues that sometimes financial institutions make mistakes. So we highlight them in our slides, but of course we didn't cover all the details because if we look at the standard, there are so many different rules, but here we just highlight the essence, the key issues, help you to understand in your compliance activities. I will stop talking now and give the floor back to Daria. Thank you.
Sorry. Thank you, Colin. I will now share the questions. We will start from the questions which we didn't answer yesterday. And Colin, please feel free to to ignore those questions which were discussed today, because some of the questions were raised yesterday, and I think that some of them were answered during today's presentation.
Yeah, sure. Okay. Thank you.
And I marked with yellow the English translation or the English text of the questions which we ask you to answer today. If you don't understand the question, please let me know.
Okay. Maybe I can start and I can take turn with go. But the first one, maybe I can take the first one. When does a financial institution report information about account turnover, not balance? The question is about the movement of activity or money in the accounts rather than just the account balance. I think this we have just talked about maybe 5 minutes ago. So you don't need to report the turnover or movement of the activity of the money. You just look at the account balance by the end of the reporting period.
And considering that this is a question from the bank, I guess the question was about the depository account.
Yes, they mentioned the bank account, so it should be a depository, I presume, yeah.
The next question is also from the bank.
I can take that one. Is it enough to have entity self-certification specified that is not a non-reporting financial institutions to not further proceed with due diligence? No, in principle, it's not enough to have the self-certification because it's a two-step process. We must have the self-certification and then control the reasonableness of that self-certification. So we have a self-certification in which an account holder states that it is a financial institution, if it's a non-reporting or a financial institution or any type of financial institution, then we also need to check, verify the documentary evidence and public available information in the file to confirm that that's the case. If there's no information that raises reason to believe that the information contained in that self-certification is incorrect and not unreliable, if there's no such information, then we can, there's no further procedure needed, because financial institutions, including non-reporting financial institutions, are not subject to be reported.
Okay, I will take this one. The account holder has a financial account in Ukraine and has a registered residence address in Ukraine and a TIN of another jurisdiction, for example, Italy. In his or her self-certification, the account holder identified the current resident address of that other jurisdiction and provided a supporting documents in relation to the resident address. It is the account for the is the account reportable for the reporting FI of Ukraine? The answer is yes, because in the self-certification, the account holder has already provided the current resident address of Italy, and also provide the TIN of, you have the TIN of the Italy, but UK has provided, and if they provide the residency information of Italy, this will be treated as a reportable account. Definitely. And also you said they provide a supporting document, which is actually good. But you have to do, what you need to do is just to do the reasonableness check. If they self-certify themselves to be in Italy, and also this is in line with the information you obtained for other regulatory purposes, there is no conflicting information. Let's say they are residents in Italy, and then in the other documents, they also say that I'm also resident in the UK, and maybe they are dual residents. So you have to double check, further check with them. But if they don't have the conflicting information, you can pass the reasonableness check and treat this account as reportable.
І я ще хочу нагадати, у нас в податковому кодексі в статті 39 прим.3, яка регулює порядок.
Article 39 of Ukrainian tax code that regulates the implementation of CRS. It is directly mentioned that if a person is the tax resident of Ukraine and also of some other jurisdiction for CRS, this person is considered as the resident of that second jurisdiction. So if there is Ukrainian residence, it does not mean that you will not be checked as the foreign residency. I think that was item 2 of the article.
This question is from the bank.
Miguel, you want to take this, or you prefer? You are mute.
Thank you, Colin. I can take the next one. Should the reporting financial institution aggregate for CRS/FATCA purposes the values of an individual account, for example, HBA, with the value of an entity account if the first mentioned individual account is a controlling person of the relevant entity? So the standard for requires the aggregation of any account that is held by the same account holder, and in the case of entities, any other entity that is a related entity to that account holder. So that would mean that if I have 2 accounts, then I will have to aggregate the balances of those 2 accounts because I'm an account holder individual. And if an entity has 1 account and a related entity of that first mentioned entity, for example, the parent of that entity has another account, then those balances should be aggregated. However, there is no requirement to look at the controlling person to then aggregate the balances of those accounts for purposes of conducting the customer due diligence procedures or reporting the information.
Thank you. Let's move on. This question is simple, but it is long to read.
Okay, I will take this one. An insurance company maintains or savings long-term life insurance contract with an individual resident in another jurisdiction. The contract has a fixed term, let's say 10 years, but the issuer must pay a cash value in the case of early termination of the contract. According to Ukrainian laws, the issuer as a tax agent is responsible for withholding the tax due to payment under the contract. The issuer is then reporting FI. The insurance contract has a fixed term. This is relevant for excluded account. The insurance contract has cash value. This is relevant for reportable account. Since the issuer is responsible for withholding tax, the tax avoiding risk are minimum. Should the issuer report such account? Okay, so this is I think this is the question of excluded account. As for excluded account, you mentioned the term life insurance contract. As for whether this product will meet the term life insurance contract or not, the first question is you have to check the domestic law if this actually allowed under your domestic law. If that's allowed, you have to check whether you have meet those specific requirements of this excluded account. Because, for example, the insurance contract has a fixed term. It doesn't necessarily mean that this will definitely be treated as an excluded account, because there are other requirements. You have to tick all the requirements are met, and then you treat them as an excluded account. Because under the CRS, under the standard, we have very detailed requirements for what types of term life insurance contract will be excluded under the CRS. I think that's the answer to you.
I will sum up, if you don't mind, Colin. Це від кого питання? Вікторія. У нас, коли ви...
Victoria. The first thing that you do, you should define if your contract is a financial account in line with the definition of the life insurance account. If it's the case, then this is a financial account, but then you can check if the criteria met to exclude it. For insurance contracts, there are clear criteria, and you should meet all relevant criteria, regardless of the value of the account, if it's low or high account. If you are a tax agent during insurance payments, it doesn't matter. It is matter to meet all the criteria for excluding account. If you meet these criteria, then this account is non-financial. If you do not meet criteria, regardless of the whether you believe that this is a risky account or not, etc., you need to verify this account and to report accordingly.
Let's move on. The next question.
Наступне запитання. Це цитата з стандарту CRS.
You are mute, Miguel.
Thank you, Colin. I was just waiting to see if I take this one. So section 2, per C, where a balance or value threshold is to be determined as of the last day of the calendar year. The relevant balance or value must be determined as of the last day of the reporting period that ends with or within that calendar year. What those or within that calendar year means, I think
Що
that
означає ця фраза «або протягом нього», протягом цього календарного року?
Something that was covered during Colin's presentation on the information to be reported. So basically we have the calendar year as the first indication. So we will have from the 1st January of every year to the 31st December of every calendar year. However, if you, for your own purposes, for example, investment entities that are reporting financial institutions such as the trust do not have this balance as or value as of the end of the calendar year, so 31 December of every year, but rather determines that balance, let's say in June, was the example that Colin said of that year for purposes of the annual report. Then, because that date is within the calendar year that we are referring to, then we can use that balance or value for purposes of the reporting and customer due diligence procedures.
Thank you. Let's move on.
It's my understanding correct for determining if the individual account is reportable. The main thing we take into consideration is not the availability of a passport of another jurisdiction held by a citizen of Ukraine, but rather the de facto place of residence in another jurisdiction over 180 days within a calendar year and availability of and the payment of taxes in that other jurisdiction at the time when the due diligence procedures are applied by a reporting FI. So I think the question, if I understand correctly, it's about the residency, determination of the residency of the individual account holder. So for individual account holder, you would rely on the information self-certified in the self-certification form of the individual account holder for new individual accounts, of course. And they will self-certify where they are residents for tax purposes. From the FI's perspective, what you need to do is you only need to do the reasonableness check against the information you obtained already in your files or by required by other regulatory purposes. You don't need to specifically to analyze whether they have 180 days, whether there is a double tax treaty between Ukraine and the other country, how to analyze. So you only rely on the information self-certified by the client, and you only need to check if this information is consistent with what the other information is provided. For example, they say, I'm resident in Ukraine, but at the same time, they say that I'm a tax resident in Ukraine, you don't need to report me. But at the same time, in the other document, they say that I'm resident, I have a place of residence in Italy. And in such case, this reasonableness check test will not be passed, which means the self-certification cannot be validated because there are inconsistent information. So again, to sum up, you rely on the information about the tax residency from the account holders. You only need to do the reasonableness check against your existing information to see if the self-certification is valid or not. You don't need to analyze because this will be a mission impossible to analyze all your accounts holders where they are resident for tax purposes. And it's also a technical issue.
І я ще хочу наголосити, що фінансові установи
I would like to emphasize that the financial institutions are not tax consultants, and you're not obliged, and you're not don't have qualification actually to define the tax residency of your clients, of all of your clients.
Let's move on. Question 22.
Thank you. What components does the value of the contract have? I'm guessing that you mean the cash value insurance contract. So in that context, what it is considered a cash value for that contract is any amount that the holder of the account, of any beneficiary of the account, can obtain from the financial institutions. Either as a loan, for example, if I can access a loan through the financial institution because that cash value insurance contract, that is considered as the cash value of the account, or if in any other way I can demand the insurance contract to give me any amount of money during the term of the contract. any amount other, of course, than the amount that is paid upon the culmination of the event that is foreseen within the contract. So any amount that I can access during the life of the account upon the surrender of the account, but not the culmination of the event provided by the insurance contract, is going to be considered as the cash value of that insurance contract, of that cash value insurance contract.
The next question is 26, but we already discussed this one multiple times.
Yep.
The next question is 28.
28, yeah.
Is already, I think,
Similar one.
Yeah, very similar. Do you want to comment, or we can just move on? Because it seems that we have discussed it.
Yeah, for establishing the reasonable tax purposes, we have already, I have just actually introduced the basic principle.
Yeah. So we are moving to the questions from today's session. I will take the first question of 29's questions comes from the bank, and it basically we are asked how should we decide, how should we determine the controlling person, which thresholds should we use. I will switch to Ukrainian. Колеги, контролююча особа.
Dear colleagues, the controlling person, this term used by the CRS, but this is the beneficiary owner according to IMA legislation. Just not for you to be confused. So just different terms for the same concept. In our legislation, it's 25% for direct participation. This is the threshold, and it also can be used for the CRS. The only thing is that when it comes to trusts, the CRS clearly defines beneficiary owners, so you can use IML. But according to the to CRS, all these specifics of CRS, so to say.
I think that it is also very similar to the previous one. We have around 8 million of temporary displaced persons who currently reside in foreign jurisdictions across the world. And I am almost sure that those persons who spent 2022 and still reside in the foreign jurisdictions, they have already become the residents of those jurisdictions. But the question is, considering that all our financial institutions know about this situation, that most of their clients, well, most is not the proper word, but that some of their clients may have become the residents of foreign jurisdictions under the pre-existing accounts. If they know this, but formally they need to apply the due diligence rules, and they do not require immediately contacting your client, each client, and asking him or her about the changes in the residence status, unless it is expressly mentioned in the standards that you need to obtain the self-certification. So this general knowledge, does this require an RFI to do something in addition to the due diligence, in addition to those steps which are described in the standard for pre-existing accounts? Does it make sense to you, of what I explained? I mean, for instance, a bank has has 1 million bank accounts, and 50% of such accounts are individual accounts. Some of this substantial portion of these accounts are pre-existing accounts opened before 2022. And in 2022, 8 million of Ukrainian citizens, they became refugees or temporarily displaced persons, and they all reside in foreign jurisdictions. And a reasonable person in Ukraine knows about this. But all these accounts are pre-existing accounts. And we have a very clear steps which we as a bank must follow for determining the reportable status of the pre-existing account. So, for instance, if this is a low value individual account, which is most likely the case in most cases, that this will be a low value account. The due diligence procedures do not require the bank to apply the relationship manager test. So we just need to look at the files which we have, and our banks and other institutions are concerned if this knowledge about the possible change of residence with respect to most of their clients, if they need to do something in addition to the due diligence rules which they clearly have in the standard and in the Ukrainian legislation which implements the standard. Colin, Miguel, do you want to comment on that? Because this is a very popular question.
I mean, this is more like a domestic, very unique and domestic issue. I mean, for the displaced persons, because the general principle of the CRS is for the individuals, we rely on where they are resident for tax purposes. So I don't know, for example, if they are now, for example, one person residing in France, can they self-certify themselves? Are they treated as tax resident in France? Do they pay taxes to tax filing in France? Are they treated as tax resident in France only based on the tax treaty between France and Ukraine? I think it's a very technical question. It's really case by case. If generally they are not filing taxes in France, they are not treated as tax resident in France, and in such case, they would just be treated as Ukrainian residents. That's my view on this. So which means they are just treated as domestic residents. Again, it's really case by case, because the ultimate purpose for CRS, from our perspective, collected information is to collect the information of tax residents which are actually residents in other countries. Like if there was a tax resident in France or in the UK, they hold a lot of financial assets in Ukraine. The purpose is to make the such assets transparent. But if because of the known reasons that they are refugees, they temporarily resident in the other country, I don't know if there are any release rules of France or like in other countries, they don't treat them as tax residents, and they basically don't need such information for French tax authorities' perspective. But again, I mean, it's a domestic issue. I'm not confident, to be honest, to say that for sure this must be the case. But the general principle is that if you're resident in France, you should be captured. If you're not resident in France for tax purposes, then you shouldn't. You're just treated as domestic.
But I think that the general recommendation here could be that financial institutions should be prudent and should follow the rules described in the relevant section of the standard, depending on the type of the account. And the RFI is not required to do something which is not established by these rules. So if the rules say that you can rely on the existing documents that you have on file, then all you need to do is to analyze these documents. If the rule tells that you must obtain the self-certification, that you must obtain the self-certification. If standard does not require obtaining the self-certification from you, then this depends on your institution's approach, whether you will or will not collect the self-certification. So don't do anything which is not required from you. Do you agree with this?
Yes, fully agree. That's also what we mentioned today. For pre-existing accounts, you only rely on what you have in your system. There's no requirement to contact all of them again.
I think this is a very obvious question and answer, and I think yes.
Yes. Do you understand? Yeah, we can move. I can hear it.
Yeah, we can hear you.
Do I understand correctly that if we cannot reach out to the client and receive the client's tax resident information with respect to pre-existing account, we must still report the account based on the indicia that we found? Correct. The answer is yes. You can take that one as well. The other one was very short. Do we understand correctly that the rule about the status of type B investment entity that is resident in a non-participating jurisdiction is only relevant for custodial accounts, or can they be depository account as well? It can be in any financial account that the type B investment entity holds. It may be the case that that type B investment entity has a custodial account and then is relevant for the custodial institution maintaining that account. It can be that it has a depository account, but it can also be the case that that type B investment entity is investing and is having equity or debt interest in another investment entity. So it would be relevant for that investment entity holding the equity or debt interest. So it's any account held by the type B investment entity that is located in a non-participating jurisdiction. This is not limited to custodial or depository account, but it can be any kind of financial account.
The next one.
I could take this one. If a reporting financial institution identifies more than one indicia connecting the account holder to different jurisdictions and FI fails to obtain documents under the current procedure, should FI report the account as reportable for multiple jurisdictions as per the indicia? Yes, that's very clear rules under the CRS.
The next one is also very easy.
Okay. If an entity is a resident of France with a controlling person who is resident in Italy, is that one reportable account or two reportable? There is only one account. The accounts will be treated as reportable accounts, but this account will be reported in exchange to both France and Italy. But the account report, there will be a different account report, but that's not an issue of the CRS rules. It's more an issue, a practical issue of the XML files. How many XML files you need to create? Because you may need to create two separate XML files, one for France, the other for Italy. It depends. I mean, it depends on also, again, your domestic, how you actually collect and gather those information. But from the rules perspective, there will be one reportable account, but it will be reported in exchange to two countries.
Наступне питання 44. Я його не перекладала, тому що у нас...
Question number 44. I did not translate it because this will definitely be included in the further explanation that the Ministry of Finance will be publishing. So we will not elaborate on that.
I didn't see Miguel unmute himself, so I can take this one as well.
Okay.
Oh, you can. Go ahead.
Okay. If client declares in a self-certification that he is resident in Ukraine only, but we have indicia suggesting that the client might be resident in another jurisdiction, what does the bank should do? So in that case, that is the perfect example of how the financial institution controls the reasonableness of the self-certification. So in this case, because the financial institution has reasons to believe that the self-certification is incorrect or unreliable because it has documentary evidence or otherwise public available information contradicting the information in the self-certification, what the financial institution should do and is expected to do is to, if it's in the onboarding process, then reject the self-certification, do not finish the onboarding process, and ask either for a new self-certification or reasonable explanation or documentary evidence to support the first self-certification. If the indicia comes after the client has already been on board, for example, because I opened my account in June, but I changed my residence and I provide the documentary evidence in August later in the year, then what the financial institution should do is approach the account holder and again obtain the new self-certification or the reasonable explanation and documentary evidence supporting the status of the self-certification.
The next question, I think we have already discussed the issue with temporarily displaced persons, so we will not focus on this question. The next one is 47.
47, cash value insurance contract. What if the contract obtains cash value starting from year 3? Do we have to report for year 1 when the cash value was equal to 0? I think the first step for cash value insurance contract is whether you identify whether this type of insurance contract is a cash value insurance contract or not. If it's a cash value insurance contract, you categorize them as a financial account. And of course, if it's a reportable financial account, you report them. Because the cash value may change. I just want to mention, maybe worth mentioning, when we talk about cash value, it also includes the surrender value. Or, I mean, you have to refer to the definition of the cash value, what should be included when you calculate the cash value. But in practice, maybe that's the case. Year 1 and year 2, you just bought the insurance contract, and then probably the cash will be nil, which potentially may be possible. But when the general principle is when you treat it as a cash value insurance contract as a financial account, if it's a financial account, and then you have to report it. As for whether the value is 0 or this year is 0 or next year it's changed, you still have to treat it as a financial account reportable. And the reporting is an annual thing.
Thanks, Colin. I will take the next question. It is jurisdiction specific. Щодо ІПН.
Regarding TINs, we have the definition in the tax legislation. What is a TIN for Ukrainian standards? This is either YEDRPO, the common number, or for some types of organizations, and for example, as a separate institution, and the tax number can consist of 9 numbers. If the unit, for example, doesn't have a YEDRPO, we have Clear Order 1588, which says that what is a tax number? Everything is pretty clear. As to the absence of publications on the website of OECD, you don't need the publication. This is part of the tax law. and it clearly states what is a tax number for a legal entity. As to VAT, yes, it is unrelated to CRS. As to the second question, if the client states ЄДРПО, do we have to ask them to pre-fill the self-certification form? Yes, if it's depending on whether it's active or passive organization, you will have to identify the beneficiary owners.
Miguel, I was going to ask you, according to our work plan, you mentioned that you were willing to have another workshop and devoted to the reporting rules. Can we have it, if I remember correctly, it was scheduled like on the beginning of the next year, or do you have such workshops? Because we have a lot of rules related to reporting, and we internally will arrange something like workshop closer to the reporting date. And I was going to ask you if you arrange something about reporting, some targeted workshops.
Yeah, I mean, we can definitely accommodate that. Sometimes we call it a refreshing session or refresher session, which basically just right before the filing deadline, the financial institutions, they have started to collect the information, but they have a lot of practical information. So this session will be dedicated for that purposes to help them to resolve some practical issues they have in the actual reporting period. So we can definitely do that next year before the filing deadline sometime.
Тому, колеги, слідкуйте за новинами.
Okay, in this case, colleagues, please follow the updates of CRS page at the State Tax Authority website, and when the reporting forms are adopted, please expect some announcement on some workshop that will be focused on this topic specifically. For now, our task is to help you understand the due diligence rules, and this is something you're going to have to face from the 1st of July.
The next question, I will take it. It was addressed to me. Ніно, з приводу вашого питання.
Nina, regarding your question, there will be an explanation from the Ministry of Finance, and it will be described therein.
I think that all questions which were written down are answered. We can move to people who raised their hands. Yeah. We'll start from Natalia Demina. And Natalia, you can now raise your question. Наталія, ви можете задати питання.
Natalia, you can ask your question now.
Do we have to unmute them? I don't know. Do we have to unmute them, or they can just unmute themselves?
They can unmute themselves.
Okay.
I gave all necessary permissions. Окей. Марія, переходимо до вас.
Okay, Maria.
Марія, будь ласка, включіть мікрофон.
Maria, please turn on your microphone and you can ask your question.
Так.
Can you hear me?
У нас є питання
We have the question from Ощадбанк. At the moment, there's war in our country and many people are staying abroad, and we do not have the opportunity to contact them. Their phone numbers may be changed, or we cannot send them letters because letters simply don't reach the recipients. Would it be a documentary evidence when we write a message to the client's numbers, to mobile phones, Telegram, WhatsApp, and add the screenshots? Would that be sufficient evidence that we have made every step to take this, to find out this information? Maria, this is a very peculiar question. Are you members of NABU? Yes, we will have a specific questions on NABU. We will save this question because it's a very, very peculiar question and I cannot answer it off the top of our head. Okay, another question. Regarding controlling persons, we can't always sign the documents of CRS CP active assessment, and self-assessment documents are saying that there has to be a legal reason. If there is no legal reason, can chief or director, chief accountant fill out that paper? Or can we add qualified signature to this document? KBV. By KBV, whether you can sign it with cap? Okay, you need to rely on your procedures, on your AML and compliance procedures. If you accept the documents signed by the electronic key, then it's an absolutely valid document and there's no problem about that. Okay, tell us please then, instead of controlling person, can it be an accountant or CFO or director signing that? What if the controlling entity is abroad and we don't have the chance to send it? Okay, I will forward this question to the colleagues. If there's no answer, we will also add this to another meeting with the Anti-Corruption Bureau.
Have you heard the question? I will.
Sorry, you finished, Daria? Because I hear you. I see you are still speaking, but I can't hear anything.
You can't hear anything?
I can. Weird. Yeah, maybe.
Oh, you can.
Yeah, you can hear me okay and see me okay, Colin, because I can see and hear Daria quite all right.
Okay.
Yeah, the question is following. For instance, we have a passive NFV with a reportable person, with a controlling person who is a reportable person, or the question is related to collection of self-certifications from controlling persons. And we allow that the self-certifications on behalf of controlling persons can be submitted by the account holder, meaning the entity itself. But the question is, do we need to ask for the power of attorney or any other documents that certifies that the director of the Ukrainian entity or that other signatory has authority to sign and submit the self-certification on behalf of the controlling person? Or is this internally domestic issue which we can regulate?
I think I agree that you attorney and the customer, if they want, they have the full authority to sign the document on behalf of others, and the others will they will take the full responsibility if they are providing incorrect or false self-certification in the information. But again, as a general principle, we discussed it today, I think for most of the accounts, I'm assuming maybe it's not accurate, because for most of the financial institutions in Ukraine at the moment, I suspect most of the accounts are pre-existing accounts because there is a ongoing war there. I don't know how many new accounts will be opened. And also we have the situation that we have a lot of people living temporarily in other countries. And so the focus will be probably our primary focus or main focus will be on pre-existing account. But don't forget that for pre-existing account, the general principle is that you rely on whatever information you have in your system. There is no specific or mandatory requirements that you must contact all the clients. There is only one issue we mentioned is about the collection of team, which is the only issue we mentioned about the collection of team, which requires the so-called reasonable effort. But you just mentioned that when you want to collect a team, you can reasonably reach out to them, like you send them emails, you call them, you send them messages. But as long as you do this reasonable effort, that will be in line with the requirement of the standard. But in most of the cases, for pre-existing accounts, in your system, you have what information you just report based on your what information you have. There is no requirement to ask all of them to provide the self-certification again for pre-existing accounts, just to re-emphasize that. Thank you.
Thank you, Colin. Марія, ми ці питання тоді залишаємо на...
In this case, Maria will leave this question for that meeting, but I think you've heard about the general approach. Yes, we have, but frankly speaking, I didn't quite understand whether or not anyone can sign this form except for the controlling person, controlling entity. Can we discuss this on the separate workshops with the National Anti-Corruption Bureau? Yes, that's as per Ukrainian legislation. We have another question, Daria, if possible. As to the reporting, if the end beneficiary owner is a resident of 3 jurisdictions, do we have to apply 3 times or to different jurisdictions? Because we understand that they should have their own TIN in every jurisdiction. How do we indicate this beneficiary owner?
Thank you. Daria, do you want us to go ahead?
Добре. How do we indicate that information in the reporting forms? Should we indicate TIN 1, TIN 2, TIN 3 in different jurisdictions? Or do we need to fill out this information 3 times and submit the same information about the accounts of that client?
You were saying something, Miguel?
Yes, thank you, Daria. So that would depend a little bit from the Ukrainian perspective. You are implementing your own reporting format and you are not relying on the XML format. If you are indeed relying on the XML CRS schema, in the CRS XML schema, there's a field to put the country code of residence for tax purposes of the account holder. So in that field, we will select the particular tax residency of the account holder for the jurisdiction that is being reported. So we will add that and we will put the tax identification number for that account holder. And we will have to do the same for multiple account reports for every other jurisdiction that is a reportable jurisdiction with respect to which the controlling person of the account holder, this would apply the same for both for account holders and controlling persons. So there is indeed a field in which financial institutions can select the res country code for the account holder being reported. So there you will select the tax residency and include the tax identification number for every controlling person or account holder. And then if you have that the same account holder or controlling person is resident for tax purposes in another jurisdiction that is the reportable jurisdiction, we would complete another account report and we will have another field to put and complete the res country code, the residence country code of that account holder and the new TIN. So there is that possibility to indicate the country of tax residency and the tax identification number for each country of jurisdiction of tax residency.
Thank you, Miguel. Марія, вам відповіли на питання?
Maria, did you receive this answer? The structure of the report envisages the possibility of several account reports and several records. Do you, well, depending on whether you need it for final beneficiary owners or otherwise, you provide the information as many times, as many jurisdictions you report to.
Entity account, рахунок організації, і ви вказуєте там, що
The
це...
entity account, and where you state that this is a passive non-financial organization. If you do not include information about beneficiary owner, this will be considered as an error and report will be not accepted. That is, for the reporting, let us not discuss details now because we will have a separate meeting to discuss all the issues.
Я зрозуміла. Добре. Скажіть, будь ласка, буквально ще одне питання.
Just one more question, if you allow. In the comment,
Документ самостійної оцінки ми маємо заповнювати під
the comment says that every account, that should be every account. Is it enough to have self-certification for the customer, or should it be self-certification for every account? If our customer has 10 or 15 accounts and they can be opened in different times, it could be in a month or in one day or in a year. How can we properly fill in the self-assessment, self-certification?
Заповнити один, скласти один документ і вказати номери.
You can have one document and mention teens there, or to include some general phrase allowing to clearly identify what account is evidenced by the document. For example, if you have an audit by the tax administration and you have their teams, and for example, the tax administration says, give us self-certification for the number 5, 25, and 38 on the list. And you need to provide self-certification for every account. To be able to clearly link the document to a team, you need to organize the process properly to ensure that there is the link between the document and a team. For example, we don't have the box filled in the document, and this means that the client can just add in writing with his or her own hand the amount of the number of such amounts. You can just update the self-certification. The form that you've downloaded from the website of the Ministry of Finance is only an example. But depending on your needs or depending on your policy, you can update it and to add some additional fields there. For example, you can include there your AML questionnaire that you usually give to your customers or clients. It is not forbidden. So it is very important to get the information, but the form can be changed or updated. If you have customers with multiple accounts, you can include a field where they can add the information about these accounts, allowing you to find self-certification for every account that can be audited further.
Добре, я дуже вам вдячна, дякую. Скажіть, будь ласка,
Thank you very much for your answers. I have a next question. Will we have a possibility to ask additional questions? Are there any other workshops planned? we work through through associations. So this is the question to your associations. Alessa, do you remember the responsible person, our contact person with this association? We just accumulate questions from the association, not to receive like millions of duplicated questions. That's why we ask association to accumulate, aggregate all the questions, and basing on these questions, we organize workshops. We've had it with the National Anti-Corruption Bureau, and we've already got some questions. Perhaps they include your questions. Yes, we had questions, but unfortunately, we're not able to receive answers to all our questions. Our contact person is Ludmila Matvichuk, so you can contact her. Yes, I have her contact details. I will just contact her. And I think so. I'm not sure maybe what person is responsible for obtaining questions from you, but this is our contact person. Thank you very much for the information. Now, I would like to draw your attention to the fact that we had a whole range of questions related to how identify beneficiary owners for different types of organizations. So we had a lot of questions for EC, for organizations that have in their structures EC. We are not answering these questions today because the Ministry of Finance have been defining the methodology of how to identify beneficial owners. There is already a project, a draft of the document. There is a working group established, and a lot of questions will be answered there. We have not seen the final document. That's why we cannot now provide consultations, not to contradict the content of the document. But this will be a mandatory methodology. So please follow updates on the website of the Ministry of Finance. I'm not sure that that methodology has been already, the draft methodology has been published, but yesterday there was the meeting of the first working group. But as soon as they get the draft final version, they will upload this on their website. So please follow their updates.
And I think that we covered. I think we covered most of the questions, and I think we can wrap it up. Yeah, another question which I almost forgot mentioning. Колеги, було питання про платіжні установи.
Dear colleagues, there was a question for payment institutions. There was the question from a bank, so meaning the payment systems like Pioneer, etc. We have not asked this question to our colleagues from OECD. They've seen the question, and they've seen the translation of the mentioned question. We have already asked about this our colleagues from the OECD, and we are planning to add the answer in our clarifications. So we need to have the clear answer. We need to consult with our colleagues from the Global Forum. So, but that's actually an ongoing process. That's why this question will be unanswered today, because we are waiting for official clarifications. So please don't be insulted or offended if we have not asked your question, because we've had the question about the payment institutions like Pioneer. There were a lot of questions about how to identify beneficial owner. We cannot give you a clear answer because this is the question related to IML legislation and the methodology that is being developed now. That's why we haven't asked your questions. So, and I'm now asked to finalize, wrap up today.
Thank you one more time, millions of times. We much appreciate your efforts, and I'm very impressed how you stressed everything which we asked you to emphasize. And I think that everyone who attended this workshop learned something new or obtained the new knowledge and better understanding of the standards. And it was very fruitful, and we had a lot of questions. And so I would like to express the gratitude on behalf of all the team who arranged this workshop. Thank you very much.
Thank you very much indeed. I only joined the impressions of Daria. Thanks.
Thank you all as well for inviting us. We hope our sharings are helpful to our colleagues, and also especially the participants from the financial industry. And we look forward to see you in the future, probably early next year again. And I wish you all the best in your compliance activities for CRS. Thanks very much.
Thanks again.
Thank you very much for having us.
Усім дякую, до побачення.
До побачення.